this thing works here. All these new changes in the software. All right, how's everybody doing this morning? I got something fun to talk about today. All right, we're going to talk about implied volatility. I know it sounds really boring, but it's actually quite fun. And you're going to see why implied volatility can be a fun thing to do. All right. So, how are you guys today? It's good to see everybody here. We got a nice little group already. First thing here in the morning, waking up with me. We've got John Gasly coming in with the gold. Nice to see you, John. First thing, we got Bruce coming in with the silver today. And then we got Kirk coming in with the bronze. Nice to see you guys out here. First, second, and third place. We got more guys watching than what I put up and said hello. If you want to put your little marquees up there, I'll make you famous. All right, let's come in and talk about the markets. Markets started to turn and rally a little bit. And we've got our positions on here. And we're going to go through and readjust them. And I'm going to teach you some new strategies, some fun new ways of doing things based on implied volatility. All right. So last week we put on a whole bunch of straddles. Yes, straddles. We put on a whole bunch of straddles. I think we put on like 7 of them. And so then we went through and we put on our liquidation saying, well, we'll take them off when we make 25%. It's only been 3 days since we put them on. So, and we're doing okay. We're up about $1,600. Our big one is Tesla that popped and broke on that X2S A1. And it's starting to flush back a little bit. So we're going to come through and we're going to readjust these. I'm going to show you how to readjust them based on implied volatility. So a little bit more sophisticated process, but I don't think it's anything beyond you guys. You're all capable. So we're going to come in here and do this. But before we get started, I want to come over and look at the news. So first thing we want to do is just come and look at the news. And we're going to come over here. And Wednesday's March 26th. This is the news. So 5:30 this morning, we had durable goods. Durable come in. Forecast was minus 1.2. The actual was positive 0.9. So that was good. The consensus was -1. The previous was 3.3, 0.9. So it's disappointing in comparison to the previous, but it was much higher than the forecast and the consensus. So I don't know. Well, we'll go take a look at the market and see how it's fared today. We haven't really looking too close, taking a close look at the market yet. Durable goods orders, not counting transportation, so not counting cars. Forecast was 0.2 and was 0.7. So that was good. The consensus was 0.2, previous was 0.1. So that was really a little bit better there. 0.7 versus 0.2. 7 o'clock, an hour ago, we had the Fed speak. They probably threw a big old dampening towel on the market. Who knows? And then we got crude oil coming in 7:30 gasoline stocks. So it's 8 o'clock. We should have had those numbers in by now. Okay, let's come back over to the markets and take a look and see what we've got going. I don't think we have anything on we haven't got any, just real quick, let's pull up our UBI portfolio. And I don't think we have anything coming in today. So we can't really go and play UBI today. All right. So the only thing that we haven't got paid off yet this month. Oh, we've got everything. We've received all our money. So we won't receive any more money until next month. And so we've got to wait for those options to expire. It looks like YMAG is the next one that we'll get somewhere. Well, we get one on Friday. Let's see. Might get one on Friday. YMAG 333. Yeah, we've only got 3. We should get 4. So we'll get around, it looks like around $200, $250, $300 on Friday on our dividends on YMAG. And then that's it. And then that's all we'll get for a little while. Okay, so nothing to do there. Let's just close that up. And away we go. Hit save. And back to our portfolio. All right, so let's come in here. And the first thing we're going to do is we're just going to make some adjustments. Let's run down through here real quick. We'll just do them one at a time, shall we? Just do them one at a time instead of all at once. We could do them all at once. We could just go in here and wipe them all out. But we don't want to do that. We just want to reset our profit taking. So we're going to come in here and we're going to go to Apple. And Apple, as you can see, took off and started to run on that X2S A1 right there. So we put that on which was a straddle, which means we bought a put and we bought a call. And when you do that, the market just needs to move. Let's come in here and look at our positions. So we're going to say orders. Oh, actually positions, and we'll just go chart. So that's just the single chart, and you can see we're up 120 bucks. So the call is up $635. The put is down 515. Now remember, the reason you put on a straddle is because you don't know the direction the market's going to go. So you pick both directions. And then what happens is one loses and one makes money. And your hope is that the one that makes money makes more money than the one that loses money. So convexity comes into play. Now remember, convexity, let's go over to the options chain, and we're going to look at this as a 142-day option. So we'll go out here 142 days. Convexity is based on delta, right? So you have delta. And at the money delta, now right now we have our option, this is our call option, is trading at a delta of 0.66. See that? Now that means for us that it's making as much or losing as much money as 66 shares would make or lose, all right? That's how you can kind of think about delta. Delta tells you how many shares you're trading, because an option doesn't trade 1-to-1 or 100% of the shares until expiration. So in between time, it kind of fluctuates. That's called convexity, moving up and down that delta scale. And so as options continue to rise in price, the call option in this case, convexity will force that thing to have a higher delta. Okay. So you can see it'll go from 66 to 69, 73, 76, 78, 81. And so if it's making the same amount of money as the delta per share, that means as it goes to 66 shares, 69 shares, 73 shares, 78, 6 shares. By the time it gets to expiration, that'll be at a 1-to-1 ratio. You'll be making 100 shares for 100 shares, because one option represents 100 shares, right? But it doesn't make the same amount of money as the 100 shares, because it's an option. And so it has a delta convexity. And so the delta at the money is usually right around 50. And as it starts moving into the money, that convexity moves up and you get more and more and more money. So it makes money more quickly as it moves in your favor, and it loses money more slowly as it moves away from you. So if we're making 65 cents for every share, and then we come over to the put options, and there we can see that we have a delta of 32. Well, we're making more money with our call option than we're losing with our put option. So the put option is slowly bleeding out, but it's bleeding out at a rate of 32 shares versus our 65 shares over on the call, or our 66 shares on the call. So that's convexity, and that's how these work, and that's how these straddles and strangles work. Okay, so we got on straddles. Strangle would mean we had a little gap between them and they're a little bit less expensive, but we put on straddles, which are right on top of each other. Okay, the call and the put are right on top of each other. Then what we did is we came in and we put on an order. As you can see here, we got two orders. We got one to sell the call and one to sell the put. And of course, that's on the same ticket, so they'll both go off at the same time. And what's saying is it's saying, well, as soon as you make, and we put this on, if you remember, we said when we make 25% of the value of our option, we're going to take it off. All right, 25%. And we did that across the board. We just went in here and we said, hey, everything that we're going to put on today, Apple, Amazon, Caterpillar, Google, Mags, Meta, Microsoft, NVIDIA, PLTR, Tesla, we're going to put on a 25% profit. We're going to take it off at 25%, right? Remember when we did that? Okay. So now what we're going to do is we're going to be a little bit more sophisticated about when we take these off, because as you are certainly aware, all these markets don't travel the same. They don't have the same volatility. So you have Apple, which is, relatively calm compared to Tesla, which is relatively wild and crazy. Well, how do you know Tesla's wild and crazy? How do you know that Apple is relatively calm? And what should I do because of that? What differences should that make to me when I put on my options? Well, it means that the options are going to be more expensive, more aggressive, more volatile if you have a more volatile market like you have in Tesla, versus an option that is going to be an Apple, which is going to be a more calm, stable market. So the market might not move as aggressively in the Apple as it would for Tesla. And so what we can do is we can anticipate a greater profit percent increase on our Tesla options than we can on our Apple options. So for us to come in and say, well, we're going to put on an equal distribution in here, we're going to say, I want 25% out of Apple and I want 25% out of Tesla at the same time. We might not get it out of Apple, but we might get it out of Tesla. All right. Or we might get 75 out of Tesla and we might only get 10 out of Apple during the same period of time. So we want to look at the implied volatility of the market, because that's going to tell us which one of these markets are aggressive and which ones aren't. So we're going to come in here and we're going to say, all right, well, how do we find that out? We're just going to go into the options chain because it will tell us. And you can see a little column in here. Hold on one second. Losing my voice again. All right. Drink my lemon water too. I got some lemon water and some tea to keep me going here. All right. So what we do is we come in and there's a column here in the options chain. And if you right click on the header in Track and Trade, this is Track and Trade software. If you want to use the software I'm using, you just hit go over here to Track and Trade. Track and Trade, this is the stocks version that we're using. We use the futures version sometimes too. But right now we're using the stocks version. You can get a copy over at trackandtrade.com. It's 6 times Stocks and Commodities Annual Reader's Choice Award-winning platform. And then you can have the software that I'm using to do these options, because it's way easier to use options in Track and Trade than any other program on the market. I will say, if I do say so myself. All right, so let's get out of here and add that back in. All right, so then we're going to come in here. And, oh my gosh, my voice. Hold on. It's allergy season here. And first thing in the morning, I have a little struggle with my allergies. So we're going to come across here. There's a big alfalfa farm right across the street from where I live. I live in a condo, and we're out on the edge of town right there. Big alfalfa field. So anyway, we're coming in here and we're going to look at the implied volatility. Now in Track and Trade, you can right click on the header. It says column setup, and you can set up anything you want in there. We got all kinds of crazy things you can put in there, and you can turn on all this stuff that's in there, but I don't need everything in there because there's just different ways of looking at the same thing. So you don't need all of them on, but you can see in here, you got implied volatility right there, estimated volatility of the price. So that's what implied volatility is. How volatile is this market? So I've got that turned on in here, and you might want to turn on your implied volatility. I'm going to come down here and see if I can make the screen bigger without covering anything up. Yeah, I think we're good. Okay, so that is our implied volatility. Now, if you come in and look, this is Apple, and you can see that our implied volatility is at 32. All right. Now, what does that mean, 32? Well, let's come over and compare it to Tesla. And we're going to do the 142 day on Tesla as well. Let's go out to the 142 and look at Tesla's calls. I thought we had a call on Tesla. Oh, there it is. Look, its implied volatility is 71, quite significantly higher than Apple. 71 versus Apple at 31. Woo! Tesla is almost double the implied volatility of Apple. And that's kind of reflected also in the options premium. And so you can see that just in our option, Tesla moved $1,217 with a single straddle, right? And Apple, during the exact same period of time, only moved $117 for the same single straddle. So what we're going to do is we're going to have to start to make adjustments on our expectations. We don't want to have unrealistic expectations of what we can make on a specific market, because if we do, we may not reach our goals, and we may cause us to end up losing money as opposed to making money. So don't have unrealistic expectations. So if you're trading in a market that doesn't have a real high implied volatility, well, you can't expect the market to move a lot in a certain period of time. You expect it to move, but maybe not nearly as much, right? Half the distance or half the percentage of what one of the more volatile markets is doing. Now, the way we're going to do that is we're going to come in here and we're going to use a little table. And I want to mention something to you here very quickly. Let me pull this up Oh, let's see. I thought I already had it up. There it is right there. So this, why are the Greeks important? Now, implied volatility over 50 is considered high, all right? But what we need to do is we need to understand that when we're looking at implied volatility, we want to know if implied volatility is coming down or if implied volatility is going up. Now, we talked about this in class at the university last week. And so those of you who were in my university class, you know that this is one of those things that we're concerned about. Apple, in this case, and Microsoft could both have an implied volatility of 30. Okay, so if we come back to our software, you can see we only get one number right here. I've got an implied volatility of 31. What I don't know is I don't know if that implied volatility is coming down or if that implied volatility is going up. Is implied volatility on the rise or is implied volatility falling? All I know is I got an implied volatility of 30. Well, in this example, Microsoft 30 means that implied volatility is coming down. But on Apple, 30 means that implied volatility is rising. So if we don't have some sort of historical value to look off of, we don't know if 30 is high or low for this particular stock at this particular time. All right. Does that make sense? Makes sense to me. Hopefully it made sense to you. All right. So what we have to do is we have to look at the historical nature of the implied volatility. So if we come in here and look, you can see I got all my little indicators turned on here. I've got MACD here at the bottom. I've got stochastics and CMF, chalk and money flow here in the middle. And I'm not going to go into great detail on these. We've talked about these in the past, but I will say that we are in the accumulation stage and our MACD has rolled over and has gone from red to green. So that's a nice buying state in there. But we also have to take into consideration what's going on up here in that we are an X2SA1, which we know an X2SA1 is roughly a 50% probability that it might continue to turn and rise from here. It's going to probably come up and break those blue lights, but we don't know if it's going to come up, create a ABC, and that's going to be the bottom, and then the market's going to turn. It'll probably come up, rally up like this, make some sort of a little turn, pop back down, and then rally once again, and that would be our bottoming formation, our 1, 2, 3 ABC, or our head and shoulders bottoming formation, and then look for that market to continue to rise up out of that Darvis box, right? So we got about a 50-50 chance that that's going to happen at this level based on these indicators and based on the movement of the market through price and time, through the Elliott wave pattern, all right, and your Fibonacci sequence. So we've also got this downside projection, which tells us that if we go into, we want a higher than 50%, we could go into an X3SA1. So let me bring this down here. If this thing turns and breaks and falls one more time, we would have down in here where we'd then anticipate a rally in price back up and then get our ABC bottom formation. This right here would be an X3S A1, right? And that would have roughly a 75% chance of being a rally at that point. All right, now where do you get these probability tables at? Well, it's really simple. You come over here and you get it out of my book. I published it for you so that you can have it. Just go out to Amazon and search Lan H. Turner. You got to search that. You got to put the H in there. You'll get Lana Turner. Pretty as she is, she's not going to help you trade. So search Lan H. Turner on Amazon, and you will get my book. And you can buy that, and it's not very expensive. It's 238 pages, and it's a workbook. It's 8.5 by 11, full color all the way through, and you can lay it out on your desk, and you can look at these probability tables. And that's probably, if I were to say, the most important thing in that book is these probability tables. All right, so you want to have those, and you want to learn how this works, because if you don't, it's like going to the blackjack table and not knowing what the probabilities are of you winning on a blackjack hand. Why would you ever do that? You don't want to do that. So you don't want to do that in the stock market either. If you don't know what the probabilities are of you being profitable in a trade, you don't want to put the trade on. All right. So this is where we're looking at on these different probability tables. And we got roughly a 50% chance this is the bottom here. If it would come down here, we'd have more of a 75% chance that that's the bottom. All right. So that's how we work through the probabilities. But we want to know if the historic volatility of the implied volatility is rising or falling on any given stock. And so we've turned on, if you right click on your chart, come down here, add indicator window, you can slide down here and it says HVOL right there, A, B, C, D, E, F, H right there. HVOL, can you see it in there? Historic volatility. So right click on your chart, slide down to add indicator window, slide down here to HVol and turn that baby on. And that's going to tell you if the volatility of the market is rising or if the volatility is flushing or falling. All right. So you can see in here where the market's volatility has been rising or falling. Now you can come into this indicator, and I'm going to delete all. Let's just delete. Yeah, we can do that. All right. So we're going to come in here to this indicator. We're going to go over to the settings. Let's look at the settings. Now, the historic volatility period, it's standard, it's just standard, comes out of the box at 14, and that's okay. We'll just look back 2 weeks. And then the historic volatility, and I've got it on here. It says in here to use the relative scale, and I'm going to turn that off. And you can see that the relative scale, when it goes to relative scale, you can see I've got a line in here at 50. And if it's above 50, then we consider that to be a high implied volatility. Now, the problem with this is that implied volatility, if you turn off let's see, which one of these is it? All right, if you turn off the relative scale, oh my gosh, give me a break one more time. If you turn off the relative scale in here, what you're going to see is that the table goes from 0 to 100. All right. And then you can see where 50 is. And 50, anything above 50 is considered a high implied volatility. So Apple is currently trading right now. You can see it at 28.67% historical volatility and an implied volatility of 31.72. So these two are not going to match exactly because this is what it's doing right now. And this is what it did as of, this scale on the historical volatility scale. So this will catch up to it as it starts to rise. But right now you want to look at this one at 31.8. And then you can see that this one is currently sitting in historical at 28.6. And it is rising. Now, on a 0 to 100 scale, anything above 50 is going to be high. All right. But it's going to be based on this implied volatility down here, 31.8. Nonetheless, it's below 50. So we're going to come in here and turn off the relative scale, and we can see it. You can see it a little bit better on the line, and you can see that it is increasing, but it's not as high as it was back here. And you can see it's only 35% is the high that it's been. So that high, when you do use relative scale, will scale it to the high of the chart itself, all right, rather than based on 0 to 100. Now, the problem with implied volatility is it can go above 100. So there are times when implied volatility can go up to 150, 200, 300. It's not unheard of to see volatility as high as 300 and even higher. Some of these meme stocks, when they were going through the roof, going straight up, their implied volatility was 300-400%. That's craziness. All right. So you want to be very careful trading those because they're extremely expensive. First of all, the implied volatility can give you an idea of how expensive your premium is going to be. If it's a higher implied volatility, it's going to be more expensive. And that's why when you're trading those yield max funds on our UBI portfolio, the stocks that have really high implied volatility are the ones that pay the higher dividends, right? And that's because in the yield max funds, which the ones we're using to create our UBI portfolio, those funds or those markets have a really high implied volatility. Therefore, the options are more expensive. Therefore, because we are selling, or they are, yield max is selling those premiums to collect the premium, they can get a lot more money for them. And because they can get a lot more money for them, then that benefits us because we can then receive a higher dividend for them having sold a more volatile market, or for us joining in on that or participating on the sell and purchase of options in that particular market, right? So like Tesla, for example, that's why they have such a high dividend, is because their implied volatility is so high, making their options more expensive to buy. Therefore, if we're the sellers, which we are when we're with yield max, we're selling those options, we can collect a lot more money. That makes sense for you? All right. And that's how yield max actually determines their dividends. They determine their dividends based on the implied volatility. So that's why the dividends on Apple are much lower than the dividends on Tesla. And if you wanted to know, that's how they do it. It's based on implied volatility. So we can use that and do that in our own trading, and we can come along and say, well, you know what? I'm trading Apple. I've got some options on Apple, and I've got some options on Tesla. Should I take implied volatility into consideration? Yes, you should, in multiple ways. One, you can look at the value of the premium itself and realize that because the implied volatility is much higher, you're going to pay a much higher premium for your options. But also, on the other side, we can have a greater expectation of profit when we go to take our options off. And so we can ask for more money. That's a good idea, right? So let's go do that. Let's come in here. And what we're going to do is we're going to go back over to our charts, and we're going to go into Apple. And once again, I'm going to take this order off, because what did we do with this one here? We came in here and we said, well, let's just take it off at 25% profit. We just kind of randomly did that with all of them. We just went in there and said 25%, 25%, 25% on all of them. Well, what if we came in and we used a little bit of a mathematical model to break this up? And we said to ourselves, and if you give me just 1 second, I think I saved that little table for us over here. If I can find it, give me 1 second. I'm going to see if I can grab that table. It was right here. Maybe I won't have it right here at my fingertips. I thought I had it right here. I was going to have it ready for you. Yep, there it is. Okay, here it is. Let me bring it onto the screen for you. So what if we used a little table like this? All right. What if we used a little table like this and we said, if our IV ranking, let's see if you can see that. Can you see that? If our IV ranking level is high, above 50, our interpretation is going to be volatility historically elevated, meaning we're going to sell premium credit spreads, iron condor short. That's telling us a little bit. That's not exactly what I was looking for. The mid range is at 50 and the low is below 50. So I'm going to go find that other table. Sorry, grabbed the wrong one there. I got multiple tables for you. Here's the one I wanted right in here. I thought maybe I don't have it right here at my fingertips. Yeah, here it is. Sorry. Grabbed the wrong one. That's okay too. You can use that table for using which strategies you're going to be with. Okay, here we go. So here's the table. So if we have different stocks that are trading with different IV rankings, we're going to use a different target for our profit taking. All right. So let's say, for example, on Apple and Microsoft, let's say the current IV ranking in here is 25%. All right. We're going to only ask for 10% in our profit taking. Whereas Apple may be trading at 30%, will ask for 12%. Meta at 35 will ask for 14%. If we get down here to NVIDIA or Tesla, you can see they're way up here higher. We can ask for the 22% or the 20%. Now, we just went in and said we just want 25% across the board. But because the implied volatility or the IV ranking is not the same for all of them, we can't have the same high expectations to give us money out of each one. So we can ask for a little bit more now or a little bit less depending on the ranking. And so that little table right there is kind of the idea that I had for setting that up for us based on implied volatility, because that's what the pros do, right? That's what Jay Petrocelli does. All right, now Jay Petrocelli, he's the guy who's trading our Yield Max funds. That's his book. If you want to go get his book, it's called Buy and Hold Hedge. And he's crossed out hold and put in there hedge. This is a really good book. I'd recommend everybody go get it. It's on Amazon. I don't make any money if you go buy Jay Petrocelli's book, but it's a good book. And I think you'd learn a lot by reading it. And one of the things he talks about in there is how they use, well, I don't know if it's in that book. Yeah, I think it is. I think it's in that book. It might be in that book. Anyway, I think that's where I got that he was talking about implied volatility. and using implied volatility to determine the amount of money that we should take off when we are putting on our profit taking orders for our options, because that's what he does. And that's how he determines the dividends that he pays out on his yield max funds. So we can do the same thing over here. So what we're going to do is we're going to come in here and we're going to delete these. All right. So we're going to delete the multi-legs, which said 25%. And we're going to come in here and we're going to liquidate. We're going to say, I'm going to liquidate those multi-legs. And I'm going to come in, and this time, because the implied volatility on this was 31 on Apple, and our little table, oh, doggone it, I lost it. Where'd our little table go? We'll grab that and bring it back up again. Our little table here said that if it is implied volatility, now implied volatility is a 31. So if we come down here on a 31 scale, it's about where Apple's at right here. We're going to ask for 12% to take off our profits instead of 25. Does that make sense? So we're going to come in here, and right here, we're going to say, I want 12%, right? So we're going to come in and we're just going to run this bid down. Oh, wrong way, up, up to where it says 25%. Right now it says 3.59. Can you see that in there? Where it's blue. Might be a little hard for you to see, but down here in this bottom right corner, this little spot right here, see that? Where my cursor's at? That little number right there is telling me the percent gain I will make to take that off if the market hits my order, my limit order. And I want that to be, what do we say, 12% for Apple. So I could sit here and run this number up and it'd take us forever because it's only on 5 and we want to go all the way to 12. So I can type it in there. So let's go to 33 and see what that does. That goes to 8. We'll go to 34. That took us to 12. And we said we want 12. So we're going to go back it off right there. That's close enough. So net profit is 12% or $365. That's what we can expect to get out of this market. We're currently sitting at, it looks like chart open profit at $87. So we're going to let this go until it gives us $365. We're going to go ahead and place that order. Now, we don't want to put that on market order. We want that to be on net credit right there. And we're going to say place order. And now we don't have such high expectations for this little straddle that we put on to Apple. We're just going to take it off when it hits a 12% profit. Now, you're like, 12% profit's not very good, Lan. Well, hopefully it'll hit that within the first couple of weeks. Now, we've got 142 days. And remember, the reason we like to buy a little bit longer time frame is to give the market a little bit longer time, but we have that delta of our market. The time decay, the theta, is what we call that, doesn't start to decay until the market starts to drop off. The last month, the last 6 or 8 weeks of the market starts to drop off quite significantly. So we're out here with a little bit more time. We're not going to have such strong theta decay. Not that we're not going to, we are, but we're not going to have such strong theta decay that our market has to move like an explosive rocket to outperform it. And so that's why we go out a little bit further, buy a little bit more time. We don't have to worry about theta decaying so quickly because theta decays much more quickly towards the end of the time frame as opposed to the beginning. And so if you slide your chart over here, you can see, let's see, we got clear out to here for that Apple market to move. It only has to move 12%. And what do we do once it does? Well, it immediately take that profit off, give us our 300 and whatever it was, $365. And we can just put it right back on again and ask for another 12%. And then that'll extend the time, or it won't, whichever we decide. And we can just keep doing it over and over and over and just keep taking our 12%, 12%, 12%. And we might take 12% 2 or 3 times in 1 month. We might only take 12% once in 1 month. We might take only 12% in 3 months. But we've got a lot of time in there for that market to move at least 12% and give us our money. So that's how these strategies work. And you have a high probability that that's going to do that. Now, if you put it up to 75, 80, 100%, less likely that you're going to get your money, right? And so you have the more likely that you're going to hit that purple line, which is the drop dead line, before it gives you that 100% if you're asking for 100%. So if we come over here and we go into Tesla, let's do Tesla next. We're going to come in here and look at our Tesla. We'll come into our order. And again, we're just going to delete this one, delete the multi-leg. Now, the cool thing about this is we're going to go put this on again. And if we've already hit our target our target price for Tesla, which in this case is 22%, a little bit less than what we put on there. We said, well, it says that's only if current IV is 55. Let's go see what IV on these options chains are. Options, let's see, our positions. Does it have it right here? We don't have it. I don't know if we can even get it. Let's see. Column chooser. Can we put implied volatility on here? We probably can. Fees, gains, total gains. No, it doesn't look like we have it on the open positions. I wonder if that's something they can give us. We're going to have to go back over to the options. Okay, so we're going to come in, and that is 142. And implied volatility is 71. That's really good. That's high. So if we come into our little table and we see that Tesla, we've got it here at 55. If it's over 50, so we could go up to 25 on this one, no problem. So we could do the implied suggested target is IV divided by 2.5. So we're going to do that. Let's do our little math formula here. And we're going to come in and we'll just pull up our little calculator here. Oh, let's see, calculator. And what I'm going to do is I'm going to do the math for us. And I'm going to say, okay, the IV is 0.71. And we're going to divide that by 2.5, gives us a 28.4. So we could actually not unrealistically ask out of Tesla to give us a 28.4, roughly a 28% return instead of just a 25% return. And we could, we could anticipate that because the implied volatility is so high. Oh, I went off a delta of 71. Oh, no, it's close. Implied volatility is 72. We'll just go off the same one. It's about 28%. Should we do it again? Just because I grabbed delta instead of implied volatility. So it's let's see. Implied volatility is 72.71 divided by 2.5. So that gives us 29. So we could realistically ask for 29% return on our Tesla return. So we can come in here and we're going to say liquidate the multi-leg. And you saw where I got that number, right? I'm just taking, it says right here, suggested target is your IV divided by 2.5. So if your IV is not on this table, then you just calculate it yourself, 2.5. So you take the IV, which in this case is 72.6, divide it by 2.5, and that gives you the amount of money that you're going to expect or anticipate to take off the table and make realistically. So it's apples to apples, comparing apples to apples, comparing Apple to Tesla. So with Apple, we might only be taking off 10%, whereas in Tesla, we could be taking off 29%. So it's sitting right here at 13.52 right now. That's how much we've taken. If we would just liquidate right now, we'd get 13.52 or roughly $1,000 on this trade. But we've still got 142 days to go. So we can go ahead and we'll ratchet this up a little bit. And we'll take it all the way up to 29%. So let's go up to 100 and see if that takes us up high enough. It's 26%. So let's go up to 110. See if that does it. 38%. Oh, I went too high. Go 0.5. How's that? 32%. So we need 29. I'm just going to run it down here until that says 29%. We still go a little bit lower. Let's type it in there. 27. It's jumping around. 28. Okay, there's 29%. You see what I'm trying to do here? I'm just trying to get to 29% right here on the net profit. 29% will be $2,295. We're sitting at $1,000, and we can anticipate that over the next 142 days, and hopefully it comes in a lot sooner than that, right? And then we can put it back on and do it again. But we're going to go ahead and we're going to place our order to take that thing off when we hit 29%. Now we went up on this one because we had 25. So this one we went up to 29 because the implied volatility is so much higher on Tesla than it is on Apple. On Apple, we had to come way down. So let's go into Amazon and see what we have to do on Amazon. Now, Amazon, let's see how close we are with our table. Amazon is says the current implied volatility is 40. Let's go see. On Amazon, where's our order? This is call. We got, where's our calls and puts? Where is it? Where is it? And this 100. Oh, these are 86s. So we got to go to 86. Now we do have a call and a put. So let's go look at the call because the probability, let's see, implied volatility is 35 on the call. Let's go see what it is on the put. It's 30. So we could split the difference. Say roughly 32. All right. But we're going to go with the lower one. How about we just go with the lower one to be a little bit more cautious? We could go with 30, 29, 30. All right. Whereas the call is at 36. So why don't we go with the little bit more cautious one? Now, the problem is that we were already into this trade. And so this trade is already skewed to the upside to 35.9. So we're just going to, let's just, because we're already in this trade. And did we clear off our order? We did. All right. We already took it off. So now what I'm going to do is I'm going to come in here, right click, and say liquidate the multi-leg. And we're going to do 30 divided by 2.1. So we'll just do 30 divided by 2.5. Sorry, not 1. So it's 12. So we're going to set this to a net profit of 12, not 25. Now we're sitting at $25 right now, which is a 0.97. And we're going to take that all the way up to 12. So we're going to have to go up. Let's go up to 35 and see how that does. Make a wild guess in there. Ooh, that went way high. So let's go back down to 30. And that is 16. So we're going to go 29. And that is 12. There we go, 1266. So let's come down and put that right on 12. And that's where we're going to take that baby off right there at a net profit of 12% based on implied volatility. We're going to place our order. Again, don't do market. It's a limit order, so it has to sit there and pinned until we make that much money, and then it'll take it off automatically for us. All right, and then how do you know it took it off? Because you'll come into your charts and you'll see that one's gone. All right, so mags, well, we didn't put one on mags. But see how we got one on all of these, and you'll know one's gone. I mean, you took some profit because you'll come in here and one's gone. All right, that's how you'll know. So let's come in here to the next one we have is, let's see, we did Apple. Did we just do Amazon? That's the one we did. Let's go to Caterpillar. Oh, Caterpillar we put on. Caterpillar is not one of our Magnificent Seven. We did this as an example. Let's just go ahead and go into our options table, and we're going to exit chart options. And yes, we're going to kill that, and we're going to exit fastest. So we took a little bit of profit off there. See how much we closed out. $45. All right, so we're going to come in here, and I'm going to come back because that's not one of our Magnificent Seven. I'm just going to delete it. All right. We're just going to stick with the Mag 7. So let's do Google. Now, Google, do we have an order on that one? We don't. So we're going to come in here, and we have our little straddle on here. This is X1SA1. It's roughly a 25% chance that thing's going to continue higher. Now, it might be a little higher than that because this is a big, long drop. And, you know, who knows? It may break here. This is X1SA1. It might be equal to a 50% on an X2SA1. But remember, the long-term charts are all screaming at us to not get in here. But the short-term charts are. They're all saying, hey, although X1SA1 is not the greatest. So that's why we got our straddle on here, because we don't care which direction it goes. We just want it to be implied volatility. We want it to move, right? The other reason is because look at all this green in here. These guys have been accumulating through this time frame, and the MACD is turning, implied volatility is rising. Anyway, we're going to come in here and we're going to liquidate this thing, but we have to come in. Wait, before we do that, let's come to our options chain once again, and this one is an 86-day. And we don't have any orders on here. Okay, so 86 days. And the call is sitting at an implied volatility of 33. And our put is sitting at 28. So we're going to kind of split the difference right around 30. How's that? So we're going to say 30. So our implied volatility is 30. Let's just see what our table says. Is it close enough? And this is Google. It says 35 and then 14. Let's see the difference. So we're going to go 30 divided by 2.5 gives us 12 rather than 14. So we're going to go with a little bit more conservative. We're going to say 12. So we're going to come in here and we're going to liquidate this. We're going to say liquidate the multi-leg, and we're going to set that to 12. So we got to go up. Let's go up. Let's go to 25 to see where that goes. Ooh, went way too high. Let's go to 22, 7. And we can go to, let's try 23. 23, that's 12. There we go. 23.79. A little too high. We'll bring it back down. And right there at 12. All right, see 12 right there? So that's sitting there, and it says that we're going to make $245. Okay, so $245. We're currently sitting at negative 35. So we have, less of an expectation to make a whole bunch of money. We're going to make 12%. 12% return. Again, remember, if you go down and put your money in Cash Valley Bank, some people will wait 3 years to make a 12% return. Now, of course, we're not guaranteed that we're going to make that 12%. And if we let that thing go all the way and it stays basically within this, let's say the market doesn't move at all, little channel here. Let's put in here 12%, 679, 12, 12%, 10%. I don't know if that would be a correct, accurate move or not. 12% move, that would be $2,000. We don't need that. We need to go $245. It's only got to go $245, which would be about $500 for the other side, right? So about right in there. We're going to say the market would really only have to go outside this box, like right here by that purple line. So if it just leaves that box, that red line, that red box, would probably make our money. So that's what we're saying. We're saying we want that market to leave that red box before it hits the purple line. And if it does that, we'll make our 245. And I think that's a pretty good, I don't want to call it a bet because you're not supposed to call it bets because we're in the financial markets and we don't bet in the financial market. We invest. I think that's a pretty good investment. All right. The probabilities are pretty well skewed in our favor on that one, that the market's going to leave that little red line, that little red box. If it does, then we'll have a profit of around 245 and it'll take it off. All right. It's probably not a perfect line. It's probably more of a like that because of a time decay, right? A little more of a triangle formation, but that's kind of, you get the idea. So there we do. We have our order in there. 12. Oh, did we place it? I don't think we placed it. Hit place order. There it is. Don't forget to hit place order. Come in your orders, and then there it is. It shows up. All right. Oh my goodness. I got to turn you off one more time. Let me try and drink some more tea. All right, here we go. Let's go on to the next one. Let's go into mags. We don't have one on mags. I don't think we wanted one on mags because the volume and open interest was not there. There's just not enough players on mags. That's why we don't have one. But mags is the Magnificent Seven if you just want to buy the shares. All right, and notice it's I think we decided it was an X2SA1 because of that little break right there, and then it kind of flushed down X2SA1. Remember, X2SA1, roughly 50% chance that thing's going to be the bottom. Yeah, kind of sitting on a 17 here. All right. So let's come into Meta. And Meta is an X1SA1. So 25% chance this thing's going to go up. Let's go ahead and kill this. We're going to delete the one that was 25%. You can see the implied volatility is rising. And this was 142 days. So let's come down here and go to 142 days. And we're going to go to a implied volatility of 42. So let's see how close we are with this thing here. Our little table on Meta, it says 35, and it's actually 42. So we're going to, because it's rising, it's 42, 42. Let's just say, well, let's go look at our puts because we have already in this thing. So there's going to be a skew. A 35 to 40, let's go 30. Let's say that our implied volatility, roughly divide those two in half because it's going to be better if we had done this when we first put our positions on. The skew, there wouldn't have been much of a skew between the puts and calls, but because we're already in these markets, that skew between the put and call implied volatility is going to be higher. So we're going to kind of take an average. So 35 35 on the put and 42 on the call. So 35, 40, so let's say 30, 38. You guys good with that? All right, 38. And then we're going to divide that by 2.5. That gives us 15. So if we go with a 15, we go 15%. So now we're going to come in here. Did we take our order off? We did. So we're going to come in here to positions, liquidate the multi-leg, and we're going to put in there 15%. Rather than 25, because our implied volatility is lower, we're going to come in here and we're going to put that on 15%. And let's go up to 120. That only took us up to 3%. So let's go up to 140. That was 20%, too high. 135, 135. Okay, so that's 16%. So let's run that down to 15. I could type it in probably faster. There's 15. This goes zeros. 15, 48, 44. Come on, a little faster. 25, 23, 22, 19, 18, 17, 16, 15, 14, 13, 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. A little too far. There we go. All right, we're right at 15%. That's $1,700 on this trade. $13,000. Wow. That was, because look at this share size. Meta's $615. We're going to make $1,700 with a 15% return. That's sweet. All right, place that order. Okay. Now let's come back over and we'll do the next one. Microsoft. I got our order in here. Now, one thing I'm concerned about, when I put these in, am I putting them in for, oh, look, I screwed up. Doggone it. 133.46. Let's delete this. And we got to do it again. Why you got to do it again, Lan? Because I only put it in for the day. Liquidate the multi-leg. I said day right here. That needs to be good till canceled. Doggone it, you rotten little tool. I wasn't paying attention. I said just day, so it takes it off at the end of the day. If it doesn't make the money within one day, it takes it off. Well, I don't want that. I want it to be good till canceled for the next 142 days. So now I got to come in here and I got to redo it. 70 current, 76, 5 pay delta. Can't remember what the rate was on Meta. Was it 7? Okay. Yeah, that stupid thing. All right, let's try this again. Liquidate the multi-leg. Now I can't remember what our delta was on this one. Was it the 15? Yeah, it was. So we want to do 15%. You can't change it. You have to delete it. We'll go to see if we can change it. 130. 133. Okay. Software is going to always default to the most conservative. Okay, there's 15. So now we got good till canceled hit order. And I wondered why some of our orders were gone. That's because I did that yesterday too, when we put on the 25s or the day before yesterday. So now we got to go check the others that we did. And that one is it. See, it's on day. Oh, nasty land, made a bad mistake. Let's see if they'll let us change it. We're going to come in here. We're just going to change it to good to cancel and modify. Oh, it did. Look, I was able to change it without having to replace it. So we're going to come into Amazon and we're going to right click, edit, change it to good till canceled, modify, and it worked. We'll see if it works. Double check tomorrow just to make sure. All right, just to make sure the exchange got the update. Okay. So we did we do Google? Mags, Meta. Yeah, because we did Meta. And Meta's good till canceled. So Meta, Google's good till canceled. Amazon's good till canceled. Apple's good till canceled. Microsoft. Microsoft doesn't have one. That's why Microsoft doesn't have one, because yesterday or Monday we put it in as a day order accidentally, and so it took it off. That's why we don't have one. What about NVIDIA? Same thing. Palantir, same. Oh, Palantir, we got it good till canceled for some reason, which I don't know why. Doesn't matter. We're going to delete it anyway. And we're going to put it back on with a different. What about Tesla? Tesla. We got to come in here and we got to go edit right here. Edit multi-leg. Change it to good till canceled. And modify. Ooh, I'm glad I caught that. No, we don't do Tesla. All right, Tesla. Okay, so now we're going to come back up here. We did Meta. We're going to do Microsoft. Let's do Microsoft now. Okay, so we can right click on it up here on the chart, or we can just right click on it down here in the positions, but we can come in here. We got how many days on the Microsoft one? 86. So let's come down to 86 and see what our implied volatility is 27.28. So let's go 27. Well, let's split the difference. 27 and 22. Ooh, let's just do 25. Let's just do 25. All right, so we're going to do 25 divided by 2.5 equals 10. We can only, we can only take off 10% off this one. Doesn't move very much. So we're going to come in here and liquidate the multi-leg, and we're going to put in here 10%. We're going to run that up. We're at 38. Let's go up to 40 and see if that jumps as far enough. Oh, that's not enough land. Let's go up to 70. 79. Oh, that's kind of a funny jump. Let's go up to 50. Oh, I'm trying to go to 10%. I'm sitting here jumping all the way up. Oh, that's a minus number. I don't want minus. I think I screwed it up. I'm going to try again. Liquidate multi-leg. I'm only going to go up to 10%, so I can 38. Well, that shouldn't be that hard. Let's go 39. I didn't mean to do that. If you go edit, they don't bring you back to calculator. So you have to clear it, you have to delete it, and you have to do it all over again. Liquidate multi-leg. We need it to be, let's go 45. Just trying to get to 10%. Oh, it went too far. Let's go to 43. Throwing darts. There we go. We're at 10. I'm going to bring it down to 10%. Too far. That's good enough. $389, 10%. All right, let's go ahead and place our order. That was good till cancel, so we're good shape. We can redo that one. So that's Microsoft. And NVIDIA, oh, look, it went up and turned around. That X2SA1. Remember, that's only a 50% chance of success that's going to be the bottom, and it's flushing back down. I think we're going to see this thing back down here and break those blue lights and come back down and create an X3SA1 down here. I think we are. Could we? I don't know. It might just come down here a little bit and not break the bottom. It's got to break that bottom right there. That's the rule. We got rules. It's a rule-based trading strategy. So we got rules, and it's got to stay above that blue line, and then it's got to turn and go back up. Then that would be good. If it comes down here and breaks that, then we would be at our X3SA1. We'd be at X3SA1. So that's the third exit to the downside on your short position and your first long rally. That's why we have A1 here, A1 here, A1 here. X1S is your first exit to the downside, second exit to the downside, third exit to the downside. That's where we turn around and start to go back up. Does it always happen? No. That's why it's only 50%, 75% chance that's going to happen. Because it could just keep going down, 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 down into a bear market, right? But as of yet, Let's see where we're at out here. This is still the low of our Darvis box right here. So we're still in our Darvis box. So that would put us out there. Down in here would still be in our Darvis box. It's ugly. We don't like that. We like to break at X2SA1 and go up. But this market is very, very, very bearish. All right, NVIDIA. Let's come in here, and we don't have our order on. So how much money do we want to make on NVIDIA? Let's go take a look, and it is a 142-day option. We're going to look at implied volatility. It's sitting at 42.87. That's the put. What's the call? The call is 50, 42.50. Let's go to 55. No, not 55. 42.45. Let's go 46. So we're going to go 46 divided by 2.5 equals, we can roughly expect to take about 18% out of here, out of this baby. So we're going to come in here and we're going to take good till canceled, and we're going to make this 18%. So let's go up to 30. Did I go too far? Nope, not far enough. 31. Go 32. Go 34. Oh, too far. Let's see. We're going to go to 18%, we said, right? Right there. Oh, we got to go a little bit lower. 18 right there. 18%, good till canceled. So that gives us $509 against our $3,000 investment. Place our order. Tick tock, tick tock. So we just placed our order. How's that look? Looks beautiful. Let's go into positions, charts. Palantir. This is X1SA1. And that's the one we said has got to stay inside that little, we've got to get outside of that square box. I think that's what we drew that in there for, right? Quit that. Turn off. Okay. So, all right. So do we have an order on this one? We don't. Positions. And this is a 142-day option. So let's come in here and look at our table. Options chain, 142 days. And we're going to come down here, and our implied volatility is 68.35. That's the put. What about the calls? 75, 68, 75. Let's go right around 70. So we're going to say 70 divided by 2.5 equals 28. So we're going to take roughly 28% out of this baby. Now that's more than the 25 that we had. So liquidate the multi-leg, and we're going to go to 28. So we're going to raise this up to 35. Man, 35. Put your fingers on the right buttons. 28, 35, 45. Ooh, that went too far. 40. 25. Let's go 41. There's 28. There we go. 28.56. Bring it down to 28 even. There we go. Good till canceled. Place order. All right, so we're going to take that one off of 28. It's got a little bit higher implied volatility, therefore we can expect it to make us a little bit more money. What do you think of that? All right, so let's come in here. The next one we've got is Tesla. We already did Tesla, so we're done. All right, guys, that's my lesson on implied volatility. I have something real quick here for you to look at. I want you to just real quickly here, while I'm going to get your Sunday school lesson, stick around for your Sunday school lesson, and I'm going to have Claire talk to you a little bit about Pitt News Magazine.
Hey everyone, it's Claire here. Are you ready to take your trading knowledge to the next level? Welcome to Pitt News Magazine, your trusted source for trading intelligence. Whether you're a seasoned trader or just starting out, this magazine delivers the insights you need to stay ahead of the market. Featuring articles from experts like Dr. Scott Brown, Aidan Gray, myself, And of course, Mr. Land Turner. Pitt News brings you exclusive strategies, deep dives into market psychology, and powerful trading techniques. Find out about the exponential power of growth, seasonal trading secrets, and even Land's latest wild eye, crazy eye iron butterfly strategy. Each issue is packed with expert trading strategies, top stock picks, key seasonal trading insights, and comprehensive analysis of commodity futures and ETFs. You'll also find tips on technical analysis, option strategies, and much more. No matter your trading interests, we've got you covered. And the best part? You can learn your way. Listen to each recorded article, read the full in-depth lessons, or watch our video breakdowns. It's trading education on your terms. Right now, we're offering a special deal. Get your first full year of Pitt News for only $19.97. That's 50% off the regular price. 12 issues of powerful trading insights, backed by our 100% satisfaction guarantee. So, don't miss out on this limited time offer. Head to pittnews.com and subscribe today. Empower yourself, enrich your trading strategies, and stay informed with Pitt News Magazine. Trading intelligence right at your fingertips. Okay, let's get back to Mr. Turner. Thanks for sticking with me.
All right, here's our Sunday school lesson for today. For every buyer, there's a seller. For every winner, there's a loser. Life rules to live by. Just remember, every time you lose money, somebody made money. And that's good for you to think about, because that means that there's a chance that next time you could be the winner and they could be the loser. All right. For every winner, there's a loser. So keep that in mind. And that's all I got for you today. I know implied volatility is a little bit of it's not exactly the most fun and exciting thing, but it is when you're taking your profits. It's a fun and exciting thing to take profits based on implied volatility. It's going to be a little bit more sophisticated. We want to be a very best swag that we possibly can, scientific wild ass guess at where we're going to take profits. And there's your strategy for taking profits on options. All right, guys, we will catch you tomorrow. Tomorrow is Thursday. Is that right? Tomorrow is Thursday. So Thursday is going to be day trading. We'll do that in the afternoon. See you for Power Hour. We're going to do a little day trading. I'm going to try a different strategy. We're going to talk about the strategy. We did the reversal strategy yesterday, and so we're going to modify that and go to the next level. And I'm going to show you the next step up on the reversal strategy, and we're going to add something to it. All right. So we will catch you tomorrow at 1 o'clock in the afternoon Mountain Time. Make the adjustment for whatever time frame you are in. And we will see you tomorrow for Power Hour. Oh, don't forget, hit that little like, thumbs up if you guys had fun. If you thought this was a decent class and you learned anything, it's always good to see the little thumbs up out there. So go ahead, hit the thumbs up, and we will catch you guys. We'll catch you guys next time. All right.